Welcome to the jungle. Back on the Russell hunt, hunting the weakest of the weak in the US markets. The Russell is the risky stocks, the small cap stocks, and there's plentiful of 2,000 components in it. There's plentiful of stage 4 already in progress that never really pulled back as hard as they could since that breakdown in October on the indexes. But remember, for an index to look like it's breaking down the chart, there has to be some stocks that were already pulling it down, some stocks that were pulling it up, and there were leading stocks. Like some people were leading stocks back into a stage 2 before the index started turning around. Same thing for stage 4s. So when you think you're close to a top, when you have a embryonic breakdown, let's say we consider that late December embryonic breakdown on the US markets, US index, and then after that you have the macro technicals, economic data showing that you're close. Maybe you could do some estimates 6 to 8 months away from a rollover of the economy going to recession. When you have all of that weight of evidence, it's like somebody starting to look at the evidence of a 2009 bottom phase embryonic bottom, a breakout out of a monthly defined bottom, and after that you could start looking at the best stocks out there leading, so you could get ahead before the market really rolls over. You'll be in the best stocks, the best quality stocks, starting to start over, and not get into late breakouts towards the end of a bull run where the fumes are running low, and people are actually going to be those are going to be the first stocks that people are going to start exiting to put their money back into the blue chips. Woo! All right, so look at this beast. I think we have a huge monthly defined one, 2013, 4 or 5 years, five years, huge top. And I think we broke down right about here in January 2019. Yeah, you had some more here. So you have a zone, and we just sunk right through. Buyers came back in, sellers came back in. The next month pulled back, but not really being able to get back above that monthly defined support turn resistance, what I call a wall, and then just getting hammered right here, going down. Very, very hard. Right now, we're going to look on the weekly if we could get some timing, but this would be very hard to get in. On the pullback here, with that close below the monthly defined breakdown line, or it's very hard right here. So we're going to have to wait. Ideally, oh, look at that here. Maybe we're going to get a bounce off by the end of the month of that previous breakout, previous support, previous resistance, return support. So might here at the end of the month, might get a pullback. And if it gets back here, maybe have the 12-month average get a little bit closer and give us a better risk reward entry right here. But remember, the setups, always check. We want the higher trend. We want pattern breakdowns. We want confirmations. You want to see the overall move. And after that, it's just a question of timing your entry. Either if you're lucky, you get it right on the breakdown, and you can take half position and then wait for the pullback to add the second half of your position. Most of the time, if you look this on the weekends or you're not like super close to the action, you're going to miss probably the initial breakdown, and you want to wait for the pullback. And what's cool about that is when you wait for the pullback, you actually get to see how the volume is. What did it dry up on the pullback? Did it hold? You get to see more clearly what was that resistance that was important. If it turns back there, then you know that it's valid. It's protecting you. You let the 12-month average catch up. All these playing the pullback looks scary, because if you look day to day and look at the news, you see that price action go back up. Oh, it's a rally. It's over. But you know better. You know that you're in a declining 12-month moving average, and most of the time that, combined with monthly defined support, turn resistance is going to help you get a low risk environment to enter short on the turn down. And if ever it goes above, your timing was off, you shouldn't be there, but you're very close because you're entering really close there. If you enter here, well, there's a big chance that it will pull back up and test, and you'll have so much of a small position size because your sell stop's still going to have to be pretty much above at that same area that you would put it if you'd wait for the pullback. So smaller position size, you have to wait 1 or 2 months. You might panic, and you lock up your NAV, that investment potential to put somewhere else. So the best, wait for the pullbacks, and that's for patience, man. That's how you test your patience. Huge top. So I can't just not see this huge top pattern here. Let's put the greedy target off. Wow. Where's this going to go? Who are you, Unifi? I do not know what you do, nor do I care. So that target bring me down all the way back down here, close to 2009s. Might hit some support here at those 2011 lows. If I'd be just doing my swing rule, I would actually move my target just a little bit up right here just to get triggered out. So even if you're doing stage analysis, when you're hitting here, you could expect to bounce back up. So you keep a close eye on where you are in that stage 4 downtrend evolution. So that is the target, and that target is presently valid right now, confirmed by that monthly defined breakdown right here that we had in January. So pull back up, and then it's just going to continue down and bouncing along the way on previously defined support, resistance turn support. Oh my God, look at that. You think that was high? Look at these guys here who bought here. Wow. Whoa. Look at that top pattern. Kind of looks like what we're having today. A higher, like a double top, but the right hand higher. And if I look here, this was the ultimate breakdown. Was that target ever reached? That greedy target? I'm not quite sure. It looks intense. Wow. Even the greediest of target was actually reached. So we'd be doing just chart trading, my chart trading framework, which is a swing rule, and you'd go full greed, and you wouldn't take the closer pattern to the breakdown line. And look at that stage 4 decline on the monthly, man. That is fear. Look at that. Huge red candles month after month, getting far away from the 12-month average, but so fast. And you actually got triggered here. And after that, continued down. But that's when you do stage analysis. When I used to start, I started with penny stocks and all that, fundamentals. Then I moved to Stan Weinstein stage analysis. I did in 2007-8. And then that's when I shorted the markets just when everything came apparent. Reading the book, even for the first time with my limited knowledge, I wasn't checking macro technicals or economics. I was looking at 3-week moving average, and I said, oh man, this is breaking down. I could have really got whipsawed out, but I got lucky. My timing was, it just fit. But after that, I moved away from stage analysis. I was doing Forex. I didn't have volume indicators. I didn't know how to apply stage analysis to Forex. So I went the classic chart trading framework. Swing rules, confirm breakdowns, put a target, go to sleep, move to the next chart. And I'd even look at the 12-month moving average violations. I would reach it or I wouldn't. Either it would come back, I'd get triggered out, or I'd reach it. And now I have evolved. It's stage analysis. It's classic chart trading framework. It's macro economics. It's 12-month moving average violations. It's everything I'm looking at. And everything's built to minimize whipsaws. Take less positions, but those whipsaws every time, 1% loss, they add up, guys. And after that, your home run winners, instead of needing a 8-to-1 risk-reward ratio, you're looking at a 12 to catch up for all those. So you're getting an emotional land in Hail Mary territory. So if you play defense and you don't get those losses, you minimize those losses even to start with, then you're not praying for huge winners. Even a 4-1 or 8-1 would be just awesome, guys. So cut those losses early. Weekly stage analysis, Stan Weinstein, embryonic breakdown right here. You're still a lot of damage in that week. Declining 30-week moving average, close below the Ichimoku cloud. But those steep and look at red candle, and then you're starting to downperform, underperform the SPX. Oh, wait, Russell. Comparing you against the Russell, underperforming it. Look at that. This is a loser stock, underperforming stock, great short. Sideways move right here. Let me get my lines. So it broke down. You could have entered here, but that's very far away from the 30-week average. So the best thing is to let it come back up. And when you get close to that 30-week moving average, Pat. Sorry, guys. Here you could have been tempted when you got that red candle to take a position here short. And after that, here was your final chance. This is just beautiful. You're really close to 30-week moving average. And when it starts turning down, you could have entered short right here, knowing that you might have pullbacks on important monthly defined supports or weekly defined supports. And if it doesn't, well, good for you. You already have a small position here. Down, pull back up. So here's another chance to add on. Oh, going back up, gap down. So that's a beautiful weak stock. That's stage analysis at its best. Never going above the 30-week average. Lower highs, downtrend. That's what you're looking for. You go in slowly, and then you start scaling in on the first few times that it pulls back towards the 30-week average. And you keep looking at your monthly chart to expect those pullbacks, see if that price action is going to sink through and go back up, giving you other opportunities to enter short. And right now, look at a huge red volume on those down days. Some good green volume, but those red days are just massacres. Can't really short right here really hard. Like I said, let's wait for the end of the month. If you maybe we get a pullback or a little sideways move, and then let that 30-week moving average catch up, and then we could probably enter right here. But the best places, honestly, is when you start closing just below that Ichimoku cloud, the support that you've had on the uptrend. And when you start breaking down below that, that's when you get the vacuum. You don't have any more Ichimoku cloud defined support, and you could play off those bounces off monthly defined support, close the 30-week moving average. So this one probably has a lot more room down because of that monthly defined target. And probably going to get more opportunities to scale in more than usual, more than the initial 3-4 shots you get at the beginning. You might get a lot more. And as long as the 30-week average keeps going down and you don't close above it, you are in a downtrend, guys. All right? So UFI, you are injured and bleeding out. Ciao, guys.